But this is a very simple way that you can compare one type of investment to another. Hey everybody, Jay Pitts, broker owner at RE/MAX Premier Properties, and I'm back for another episode of JTPU University. Today, we're going to talk about two very simple methods for evaluating investment property. We're going to get right into it. So first is the easiest. It's the most simple, and it's probably something that you can do mentally as you are evaluating, walking through a potential real estate investment. Now, this pertains to both of these methods, rental real estate, okay? It's a little bit more difficult and challenging, as you can probably imagine if you're looking at a flip property or a long-term hold on a piece of land or something like that. But really, the evaluation that I'm going to give you today, or the two methods, are based on rental real estate that throw off rental investment income. So the first is probably the easiest, and it's the 1% method. Very, very simple, okay? What you want to know is how much you're going to acquire the property for. What is the acquisition cost? Okay, now I'm going to define that as the purchase price, the closing costs, and any and all renovation expenses that you're going to use when making the property ready for rent. So if you pay $90,000 and you have $2,500 in closing cost and $7,500 in renovation costs, then your acquisition cost on this investment is $100,000. We'll use that nice round number for our calculation today. Now, the 1% rule says that your monthly rental income, gross income, the amount of rent that the tenant will ultimately pay after the renovation, needs to be 1% of that acquisition cost. So in this example, you'll need to rent that property for $1,000 a month to meet the requirement on the 1% rule. Again, $92,500 in purchase price, $90,000 in purchase price, $2,500 in closing costs, $7,500 in renovation for a total acquisition cost of $100,000, needs to rent for $1,000 a month. That is going to be the first barrier that I have to pass when I consider a piece of investment property as a potential or viable investment. From there, I'm going to go on to more sophisticated methods of evaluation. I have a simple rate of return calculation that I like to prescribe to if it passes the 1% rule. Now let's use the same example, a $90,000 purchase price. $2,500 in closing cost, $7,500 in acquisition or in renovation costs. Let's go with that $1,000 a month rental that I'm projecting for the property. Let's take that, we'll multiply it by 12, okay? And I'm gonna have to get the calculator out for this one, so please, bear with me. But you multiply that 1,000 by 12 and you get $12,000 a year in gross revenue on the property. I'm then going to take a guess based on the condition of the property, the location, my experience in the area, and how I think the property will perform. And I'm going to estimate the cost of operating this particular investment, usually in the neighborhood of 20 to 30%. A more risky, older building, higher maintenance costs, going to be on the higher side with the 30%. I might even do 10% if it's a Class A location and it's a brand new building or brand new investment property. So I'm going to take that and I'm going to reduce the gross revenue by the percentage that I've estimated for expenses. In this case, I'm going to use 20%. So 12,000 times 0.8. That leaves me with $9,600 in net income. And then I'm going to divide that into the cost of acquisition, which in this case is again $100,000. So 9,600 divided by 100,000 tells me that I have a 9.6% return. There's a lot more sophisticated ways to calculate rate of return on different investments, but this is a very simple way that you can compare one type of investment to another or one real estate investment to another. This is, and you're going to want to develop your own benchmarks. For me, I like to invest at above 10% return. So this investment's going to be a little light. But if I think the appreciation is going to be good, I might go ahead and pull the trigger because I know that these are estimates and maybe I can outperform my expense estimates. Maybe I can rent the property for slightly more than I thought when I started. But once again, start with the 1% rule. As long as you pass there, go to a simple rate of return strategy to calculate how the investment's going to perform in the future. Hope this was helpful, folks. Thank you for tuning in to JTP University. Come back real soon. We'll have another episode for you next week. Thanks.